You are familiar with gold and silver. There's a wide variety of positive and negative news traffic on social media, and it has been occupying the agenda more in recent days. Gold has started to occupy the agenda more. You can interpret these news in different ways, but one thing is clear: central banks continue to buy large amounts of gold. In this video, as we do every week, we will take a look at precious metals and the commodity market. We will quickly glance at American 10-year bonds and currencies. Let's get started. Especially after the outbreak of war, gold has gained even more attention. But there are both positive and negative news about gold. There's a significant segment of people who claim that gold is a dead investment, or that silver should never be invested in. On the other hand, there is a segment of people who believe that gold and silver have always been the only real money throughout history, and that they should be held in a portfolio to some extent. Personally, I align more with the second group because I prefer to have a certain amount of gold and silver in my portfolio systematically, and I observed a clear downward trend between 2011 and 2019. Therefore, I traded gold and silver mostly in a downward direction during that period. However, after an upward breakout in 2019, there was a massive inverse head and shoulders formation that I discussed in previous broadcasts. Since then, especially with the macro picture becoming clearer, the pandemic added some spice to it. Now, as we witness the debt crisis growing and leading to an inevitable systemic banking crisis, it's not difficult to understand why central banks worldwide continue to buy gold. So, I'm trying to keep an eye on the amount of gold and silver in my portfolio, increasing it during pullbacks and reducing it a bit during rallies. However, we still don't have a fully developed trading market for gold and silver. When silver breaks out, that trading market will emerge, and for gold, we currently have short-term trades. But I continue to increase the amount of gold and silver in my portfolio every day because I see that central banks are not making these purchases for no reason. If you look at the central banks' purchases, especially the ones in blue, you can see that their first 3 quarters of purchases in 2022 were followed by the last quarter, where a significant amount of gold was bought. If we see a similar trend in this quarter, I'll provide some data shortly. It seems like there could be a new record this quarter, surpassing 2022. Physically, significant amounts of gold continue to be withdrawn from the system. In 2022, you can see that I've been talking about it from time to time, and the American bonds caused significant losses. There are narratives like, high interest rates are going to the American dollar. But on the contrary, all the central banks in the East are selling their American bonds because they are losing money there. They don't want to carry more positions because they fear that as America continues to borrow, they may be at risk of interest rates rising further. They are especially worried about America's continuous war spending and uncontrolled expenditures, constantly raising debt ceilings, and the fear that America, at some point, will resort to printing more money, causing the value of the American dollar to drop. Especially, what Russia did to the traffic, they can do to me too. They threw Russia out of the system and made its dollars trash at the time. Russia had to carry out operations to convert some of those dollars into gold, even through Dubai and Turkey. Russia has a certain amount of dollars, so in situations like these, and why am I telling you all this? Why do central banks buy gold? Because if they were to buy American bonds, they would incur significant losses. Look, there is a possibility that they can make money with American bonds, but only if bond yields fall significantly in the short term. Yes, they have fallen a bit now, but there is not much data indicating that they will fall further in the long term. So, they don't want to buy and trap themselves here for years. They are cautious during the rising interest wave, and they say, gold is a safe haven anyway. They buy gold. Look, you can see the ratio of gold to American treasures very nicely from this chart. Since the 1970s, you can see a significant decrease from the period when interest rates hit 120%. Then, in the 2000s, we first had a gold rally and then a beautiful cup and handle formation, which seems to be in the middle stages of a much stronger gold rally when examined in the long term. On the other hand, the Central Bank of Poland made an announcement that it would continue to buy gold. Among European central banks, the Central Bank of Poland is the most aggressive in buying gold. With the gold purchases it made in the last 3 quarters, it acquired 57 tons of gold, adding to the 48 tons it bought in the second quarter. When combined, it reached a total of 105 tons of purchases, making gold account for 111% of its total reserves. The goal is to have gold make up 120% of its total reserves, as announced by the President of the Central Bank of Poland. This is an interesting piece of data. Furthermore, we see that the Central Bank of Malaysia officially announced an increase in the amount of gold in its $210 billion reserves. Another piece of data: Russia banned the export of gold. Officially, Russia has 2,360 tons of gold in its reserves, but it is known that there is an additional 6,800 tons of unmined gold reserves underground. Therefore, Russia is expected to increase the amount of gold in its reserves. On the other hand, an interesting statistic in China: the Z generation, the young generation, plays a significant role in gold purchases. Normally, the older generation would be the ones to buy and hold gold, but it doesn't work that way now. Among purchases made by the 18 to 24 age group, 37% were made by them. Here, we have an interesting statistic because a similar situation exists in India. If we assume that these young people are considered new consumers, their demand for gold and silver may change the landscape of the market. In 2024, 113 million people will be included in this group, becoming new consumers. 57% of these will be from India and China, 33 million from India and 31 million from China. What do these statistics show? It indicates that the demand for gold and silver as investment vehicles among the younger generation might continue. Moreover, there is a growing interest in gold due to a lack of trust in the system. Officials from the Swiss National Bank and some major Swiss banks, led by UBS, have started discussions on how to prevent a possible Credit Suisse-like bank run, a deposit flight. They are discussing ways to prevent and introduce restrictions on cash withdrawals in various forms. UBS has already implemented some of these measures. In reality, I'm saying that there is an unpayable amount of money in the system, and because it can't be converted to cash, physical gold and silver become important. This leads to a situation where a major problem is brewing in the system and access to your money is becoming restricted. Switzerland is one of the countries where the wealthiest rely heavily on banking services. If there is a problem there, I can't imagine what the rest of the world will face. Let's take a quick look at the gold ounce chart. In the short term, as you know, our trend following level is at 1,954, and we continue to watch it. We're approaching the $2,000 mark, and I mentioned that we might have a horizontal consolidation there. As long as it doesn't break below 1,954, any pullback here continues to be a buying opportunity. I still believe that we can reach historical highs before the end of the year, but in the long-term picture, some might argue that we've been in a loss for a long time, especially when considering it in terms of the dollar. However, personally, I don't see it as being in a loss. What's important is not to be in a loss. You can buy a product, and its price may drop, but when you buy products like gold and silver, they are already old forms of currency, so you are essentially acquiring money. You might have bought it expensively, or you might have bought it cheaply, but what's important is that in the long term, their trends are generally upward. In the short term, there is a consolidation in a sideways market, but in the medium and long term, they have already turned their course upwards. Gold, at $1,943, as long as it stays above the medium-term trend following point, I believe that with weekly closings, the movement has already started, and you can reach its near target at $2,535 by the first half of 2024. $2,750 and $6,000 should not be two distant targets, but the movement needs to start. All I've said can be triggered with closures above $2,075. Silver, in the short term, we've moved above the 200-day moving average at 23.04. As long as it remains above 22.80, which is our trend following level, we can still see a back and forth movement with an upward bias. Silver hasn't fully joined the movement yet. If it breaks above 24.10, it will have broken the descending channel, but the real movement will start after breaking 25. I've been saying this repeatedly. The real move will start after 25 is breached, and it will move towards the upper targets at 36 and 46. There is momentum towards that, but it hasn't given the signal yet. Where should we look? The gold to silver ratio, but as long as it stays above 22.64 on the weekly chart, it technically continues to have an upward bias. The gold to silver ratio is considered to have a medium-term formation, but due to the lack of any significant movement, it's difficult to make a clear interpretation. The trend following levels are 85, 84, and 78, and we've finally reached these numbers. On the last day of the week, silver's performance was more active, while gold remained relatively stable. Short covering occurred in silver. As I always say, there's significant manipulation going on there, led by JP Morgan, for years. Both gold and silver have been manipulated multiple times, and due to this, JP Morgan traders and executives have been sentenced to prison. However, someone is allowing them to do it. Either the Federal Reserve, Fed, or former employees of the Fed. The word gold is not even used within the Fed because they view gold as a rival. In the current duopolar era, countries are trying to protect themselves, and they are looking at gold and silver as investments. So, they allocate some to their reserves as a form of protection. The manipulation in this case is so clear and evident, and they have been doing it for such a long time that it has become normalized. There are intelligent analysts who explain it in various ways, but I keep saying that the manipulation here has been reflected in the courts several times. It's a real and evident manipulation, not just some story about it not going up. The clear picture here has been evident throughout history. We've seen breaks in this pattern, like the sharp movement in nickel 2 years ago, and we discussed how they put stones in reserves instead of transactions. We've discussed all these in this channel. Therefore, there's no debate about the clarity of this picture. I can have all sorts of discussions about it, but the movement will only start when one side gives up and plays in the opposite direction. That's when JP Morgan will suddenly reverse this game and start trading upwards. I feel we are getting closer to that moment. In that sense, especially when the gold to silver ratio breaks below 78, I will be sure that the movement has started, and then I will discuss these more loudly. But for now, we continue to hold a portion of our portfolio, and when the movement starts, we will increase it and start trading on the screen. There has been some movement in platinum, as you know. I've been talking about carrying a position in platinum for medium to long term for months. But as long as it remains above the $900 trend following level, I see potential for movement here as well. Platinum should be much more valuable in the long term and should surpass gold as a higher quality metal, even though we might not see that right now. At the very least, it can get closer to gold, and these movements can happen quickly. Wheat has experienced a long-term decline, but it seems to be slowly forming a base now. I observe that it has created a double bottom. As long as it remains above $554, I see potential for movement. I believe there is at least a $200 potential for movement in the short term. We can run this movement upwards by adding positions to it. However, in the long term, I understand that some of you are wheat investors. You've had some difficulties in the past, and I'm still holding a portion of it in my portfolio baskets. When the movement starts, I will even add more. In recent weeks, I've been gradually adding to my positions. Brent crude oil, there were potential target levels around $108.14 due to the formation of a cup pattern. However, the upward breakouts are not happening as there is pressure from the demand side. This is because of a slowdown, especially with news of a slowdown coming from China, which is preventing the price from rising. In the US, as you know, they are trying to fill their strategic reserves by buying when prices drop. There's a simple trade here. The 200-day moving average is an important support level, in my opinion. It's at $85.55, and we closed just around that level. As long as it remains above it, there are no technical issues, and we shouldn't fall further. But if we see closures below it, things could get strange, and even more selling may come. However, if it breaks above $88.50, we'll be looking at the bullish direction again. So, there's a band trade ongoing here. I look at Brent crude with a buying approach when it gets close to $85.50, and with a selling approach when it goes above $88.50. I'm more inclined to discuss natural gas, as you know. There has been upward pressure that broke through after months of pressure. However, due to the nature of natural gas, it often experiences manipulation since it has monthly contracts. That's why it's essential to look at these as short-term trades. They are not suitable for long-term investments, as there are challenging times and favorable times. Explosions upward can happen in various ways. Natural gas can be useful for those who can hold a small, unleveraged amount in their portfolio. We said it can be bought when it gets close to $2, and that was very cheap. Many profited when they bought it at that level. But we also said at least $3, and it reached $3, came back. We even mentioned a potential target of $4. Now we're approaching those levels, and it seems like the movement is beginning. The critical level is $3.42. Last week, we tested that level, and it went up. As long as there's no daily closing below $3.42, the potential target of $4 or slightly higher remains, but if we see closures below $3.42, it could be tiresome, and it might be better to step aside and wait. Last week, I found uranium more appealing and added some more to my positions. I'm expecting the upward movement in uranium to continue as long as it stays above $45.70. I discuss uranium through the URNM ETF, but there are various uranium mining companies and related stocks that you can also consider for investment. It's a good idea to do your own research and analysis on them. In the American 10-year bonds, there has been a divergence for the past 3 weeks. We said this would drop below 4.53 before these things happen, and there was a drop down to 4.48. Then, it closed the week at 4.57. Now, the divergence below is clearing, and if it goes above the 4.75 trend following level, we can say that the uptrend will start again. But in the long term, look at the second chart. You can see that the main trend is still continuing to rise. There has been a rise for 3 years since the 2020 low. There's actually a 4.48 trend support there. In other words, the level it saw on Friday indicates that such a strong trend could consolidate and linger for a while. But if we don't drop below 4.48, it means that only the divergence has been cleared, and the main trend can go up. In that sense, I'm looking at American 10-year bonds with caution. There were many questions about American 10-year bonds this week. Look, there have been questions about whether it can be bought as an investment, just like buying bonds, as a reverse product of TLT, due to the fact that there is still no clear trend in the long term. I can't give a clear answer to your question. The only thing that is clear is that it can go a little lower below 4.48, and in that case, you can make money from TLT or similar products. But as long as it stays above 4.48, technically we see that this trend continues with corrections weekly and such, but the recent moves are quite strong. Is it due to a short squeeze, or will this influx of money continue into a major recession, causing prices to plummet below 4.48? Sales may come towards 4.48 levels. But there is still an America that has to sell bonds, and future declines will only start if they are met with a decline on the stock side. We only start to look more positively if the stock market reacts to the drop. We can see that money is slowly coming out of the reverse repo market, and we also see that it is coming into the bond market. There has been some entry into the stock market as well, and now they cannot move in the same direction at the same time. In other words, if interest rates go down and the stock market goes up because of a recession, stocks should already be sold, so we'll continue to monitor this in a somewhat complex way. Euro/dollar. On the other hand, DXY has seen sharp declines. Is it a permanent decline? I cannot be very sure. The possibility of a downward trade for the dollar against the yen exists. However, in Euro/dollar, the 200-day average is at 1.0735, and we closed right around there. Now, we have a pattern that resembles a bear flag. This could be a bottom, so I will closely monitor this 1.0735 level. I will trade positively above it and negatively below it. If we cannot surpass 1.0735 and turn lower, the possibility of a bear flag will emerge. But we will reconsider the possibility of a bottom above it, so instead of a long-term position, we can look at short-term trades based on this level. $/yen. For $/yen, there is trading between 150.60 on the upside and 149.20 on the downside. If it goes below this range, I will turn extremely negative because a downward movement can come with a systemic issue for the yen. There has been a double top formation on the weekly chart, even on the monthly chart. But if it goes above 150.60, there is a potential for a breakout of the strong formation on the monthly chart, so do not trade without setting stops. Look, these days are very challenging, and there can be sharp movements in both directions. In the stock markets as well, you can see such strong movements up and down that protecting your money should always be your first principle. Therefore, carefully analyze these movements and try not to miss my broadcasts. I'm trying to answer all your questions everywhere. I wish you all very careful, profitable, and wonderful days in these difficult times.